So today we're going to talk about how to find the best interest rate. But there's an incomplete question. You're really not trying to get the best interest rate. You're trying to find out if your particular situation is being given the best interest rate possible. So to be truthful, there is an incomplete question when people ask, how do I get the best interest rate? Now, let's talk about how it works. Or how does it work? In particular, there's going to be 3 points that we're going to touch. 1, where to find. 2, how do I know? 3, is it worth it? And then I have a bonus for you guys. We're going to figure out to see if it actually is real. Yep, it might not actually be real. So let me dive into this specific topic. And we'll first off starting with what actually is required from lenders in order for us to figure out to see how do we even assess an interest rate. Well, I'll start off with this. Every single bank, every single mortgage company, every single lender, whether you're a broker, a retail broker, a bank, work at a credit union, it doesn't matter. It doesn't matter where you go. We all have the same interest rates. So if that's the case, what changes? What changes is ultimately the cost of the actual interest rate, which is something that very many people don't even know or understand. Now, lenders really talk about this in the form of points or basis points. So essentially, it's a 0.01% of the actual loan amount, and that cost is what changes. Every bank will have a different margin. Some have to make a little bit more, some will make a little bit less, depending on service, depending on their profit margins, depending on who the investor is, what type of risk they're taking on a loan, and a bunch of other different things. So we're going to cover those 3 topics, okay? But I got to give you a little bit of background with this whole thing before you can really truly understand how interest rates work. The idea of getting a mortgage or getting any type of loan when you're borrowing money, the idea of borrowing money, it's not free. Somebody's letting you use those funds, and they're going to, well, obviously make a profit out of letting you borrow those funds. Depending on the purpose of those funds, right, is how they address whatever their risk is. Let me give you an example. If I'm trying to purchase a vehicle, the term pretty much tells me how long I have to repay that loan. The interest rate on it, well, it's an assessment of the risk I'm going to take on that specific asset. So a vehicle, depending on the car, if I know it's going to last quite a while, I might actually give you a lower interest rate. Or if I have an overproduction of them, as long as I know that the car is obviously worth it and so on and so forth, right? Then I can give you a certain interest rate. And then comes other variabilities. Same things like what your credit score is, how much income do you make, can you make the payments, can you not? Have you had any previous past experience, with doing these kinds of things? All of that matters. So if they do that with a car, do you not think that they do that on the mortgage side? Of course we do. We have to. You're not getting a loan that you're going to have to repay in a short period of time, not 12, 24, 48 months, 72 months. Some vehicles are actually doing 72 months at this point. You're not going to pay it in 10 years, although you can get a 10-year mortgage. It's looking at 30 years. So I'm going to put something in perspective for you. If I'm 40 years old right now and I get a 30-year mortgage, somebody's letting me borrow money until I'm 70 years old. Man, that's got to sink in a little bit. If somebody's going to let you borrow money and wait 30 years to get repaid, first question I'm going to ask you is, who do you want to let somebody borrow your money? How long do you want to wait to be repaid? Do you want to work all of your life? Here's the interesting part. Do you want to work all of your life to have $500,000 and then let somebody borrow it and then wait 30 years for them to repay you? It's got to be really worth it to you, doesn't it? Or isn't it? The idea and the concept of borrowing money has an interest rate. Your particular situation, the asset that you're purchasing, in this case, the property that you're going to purchase, The use of the property and what you're going to do with it is going to be ultimately extremely important. Lower interest rates are always for primary homes, not second homes, not investment properties, not mixed use, specifically for primary homes. And a primary home is the place where you're going to live. So now that we understand that, when you're looking and shopping for an interest rate, if you call the lender and you say, hey, what's your interest rate? Well, first off, that's a wrong question. Second, we've already discussed, it's completely incomplete because it should be, what interest rate can you give me with this specific situation? There is no magic sauce, okay? So us as lenders, to avoid having to have that big discussion, what we essentially do is, well, we just arbitrarily just pick 3 or 4 items that we know are going to be the biggest ones. Things like, what's your credit score and what type of loan? And then we give an interest rate. I mean, sometimes we don't even ask how much down payment. But you got to think about this, right? The more down payment that I put on a loan, or the more down payment I put on buying a house, where my interest rate is going to be better. Yep. If I have a 580 credit score, why would I expect, to have a better interest rate than somebody that has a 720 credit score? A while back, Fannie and Freddie Mac, that thought process, they came up, with removing something that's called LLPAs, loan level pricing adjustments. Essentially what it is, right, it's a risk assessment, that says, hey, if you have a lower credit score, then we're going to charge a little bit extra for this, because we feel that there's a higher risk. Well, is it truthfully a higher risk? Absolutely. Okay. I'm sorry to tell you this, but it absolutely is. If you have a lower credit score, in very few instances, it might have been, for other reasons. But the truth is that they have millions and millions and millions of scenarios and cases and data where it shows that when somebody maxes out their credit cards, they are very likely to miss a payment, or they are very likely to, well, potentially be in a tough situation. It doesn't happen all the time, but it does happen enough times, for it to be considerable. So in other videos, I'll talk about a little bit more about credit and we'll go diving into that, but in this one in particular, we're just going to talk about how to find the better interest rate or the best interest rate. Okay, now I'm going to put a little caveat over here. Historically, people say I'm going to go to a broker so I can get a lower interest rate. Is that true? Potentially. Is it always true? No. Will it always be true? No. There is no guarantees that you going with a broker, you're actually going to be saving money. What happens is that there is a cost involved with it, and it depends on who you go to and what their profit margins is. If you want to know more about that, then drop it down in the comments, and I'd be glad, to go into a little bit of conversation on the different on pricing and why and how and where it goes. The truth is that even in the broker side, we can have really high prices. We have really high cost on interest rate. And it just depends because the bank that you go to might not have an appetite for that. So we're going to cover question number 1, where to find. See, because you need to understand the risk and the type of purchase that you're making, the amount of down payment that you're putting. You can't just walk up to a lender and say, hey, what's your lowest interest rate? Or, what's your interest rate today? Or where are interest rates at? I mean, it's kind of like saying, hey, where is the status of the education in the United States? That's what you're really asking, is like, what's the average overall? So we've learned, to just dive and kind of go around those types of questions. In reality, it is very difficult to answer, and it's particular to every single person. I've had clients, that have 2% variance between one and another, and there's no 2 mortgages that are ever the same. So where do I find it? Well, you're going to find it with the person that you actually work with, that you can connect. I know that's not the question or the answer that you want to hear. All right. You want me to give you some special sauce of go online and look at this website and search for this place and search for that place? No, I'm not going to do that because it truly is a lie. Everybody needs to make money out of lending money. everybody pays for the access to the funds to purchase a big asset. So what is the difference? Well, potentially somebody's making less money on one deal than the other. You can very well ask, hey, can I get a little bit of a discount on this? Totally fair. So you can go with the same lender and ask them, hey, can I get a little bit of better interest rate on? Because if not, you're going to go and start shopping. And I got to tell you this, it can get really exhausting because it's almost like shopping insurance. You never know. Some carrier might actually be cutting some costs in the back in order for them to do it. Some other ones are paying people less for this, So look, if you want to have a dive at that, and just call people and everything else, this is what you need to have. Your credit score, the amount of borrowers that you're going to be on the transaction, the amount of down payment that you're going to be putting on the property, or the specific program, and the specific program that you want to, qualify for, your debt to income ratio. If you have those 5 things, you are going to be able to get a very accurate interest rate. You can type it anywhere, and just call and say, hey, what is your interest rate on this? Now you have to understand when you get discounts, right? You got to also understand where does it come from? Do you want a Disney-like experience, or do you want my cousin Pablo came in here and replaced the floors and left them all crooked type of experience, but I got it done? Yes, it does make a difference. So where do you find it? Well, you find it with anyone. You just got to ask the question, hey, can I get a little bit of a discount on this? That's all fair. And if you want to shop around, you have to have those 5 points. All right. Now, next question. How do I know? Man, that's a little bit tougher. But in reality, you don't. You don't know because you're going to be in an ever-changing market. That's the other part to this, is that where do I find the interest rate? The reason why you want to just stick to one and ask for a little bit of a discount rather than going everywhere, is because the markets change 2, 3, 4, 5 times a day sometimes. Sometimes changes are really drastic. So when you go and shop with one lender, you cannot come back and just be like, oh my gosh, you were giving me such a high interest rate on this. If in reality, the market changed. Now, I'm not discounting that it probably could be, but at the same time, no, you can't do that. You cannot go and hold somebody accountable for the market changing. We don't control that. Loan officers don't do that. The secondary market does that. Now, if you want to learn more about that too, drop it down in the comments, and by now, if you haven't subscribed, shared, and liked, I think that's problem number 1. So let's make sure that you do that now. So secondary market is the one who actually updates and changes pricing and gives us the updates and whatnot. Sometimes, I'll tell you this, when you have a low interest rate, and a secondary market changes it, and you call on the right time, which us as lenders, we don't even know. I've been lending for 10 years. I don't even know when they're coming. I can kind of guesstimate, but in reality, it's a whole entire department, the desk that is making these definitions and trying to figure out, is it going to work or is it not? So be mindful of that. All right. You don't know. So then stick to your particular situation. Now, the third question, is it worth it? Is it worth it to go through all of this trouble? Okay. Instead of just asking for, hey, can I get a little bit of a discount? Can you make sure, this works out? Well, that's going to depend on you. Do I think it's worth it? Sometimes, but those are very specific situations. You would actually have to understand the mortgage industry in order for you to know if it's worth it or not. And I got to tell you, I'm going to say this, 80% of loan officers out there have no clue how this stuff gets put together. So when you're calling them and asking them about this, all they're doing is just repeating something that is being given to them. But that's how our industry works. Okay. It is very complex. So if the loan officer that you're calling might not know, how do you know if you're not even in the industry? Just because you're making a simple inquiry or you're purchasing a house once every 5-10 years? No, let me tell you, it doesn't work that way. So with all of that being said, how do I know, or how do I get the best interest rate? Well, you get it by understanding your specific situation and by knowing how mortgages get priced. That is how. Second, Ask your loan officer, hey, can I get a little bit of a discount on them? Okay. Sometimes they'll say yes, sometimes they'll say no, depending on the situation. Okay. Especially if you have a low credit score, or you're putting really low money down. And yes, absolutely. They're a lot harder, a lot more difficult, to start giving, credits on that. Please understand this too. Everything has a cost. The reason why you have a job and you're getting paid is because somebody's making a profit and they're paying you to do that. It's exactly the same thing. So it's a revolving door. Let's be careful and mindful about this. Okay. Now, as a bonus, I want to talk to you about this. Is it real? Is the discount that I'm getting real? Is my interest rate real? Is does it really make sense? Is it worth the effort? It might not. It absolutely might not be real. The part with this is that it can be very difficult, to even assess, because sometimes you'll go one lender to the other, and because you just simply didn't ask for a discount, you just went and arbitrarily asked somebody, hey, what's your interest rate? We spat out something, and then we're kind of shooting in the dark, and be like, okay, you know what? I'm going to give them the discount up front before they ask. And this actually goes for other lenders. If there's other lenders, doing this, I mean, come on, don't sell out the farm. You need to maintain your family. You need to do your family too. Loan officers aren't making as much money as you think they are. The good ones are, but just like anything else, okay? If you're in your job, for 10, 15, 20 years, you're going to get paid more than the new guy that came in, or at least you should. So let's be mindful and thoughtful about that. So is it real? I don't think so. Because if you don't have a plan to do all of this, it just doesn't make sense. You can get an interest rate today and think, hey, you know what? I'm saving a ton of money by doing this, but in reality, you're not, because you didn't know what you were shopping for. You thought you were saving money, but you're really not. So you have to have a plan. Whether your plan is, hey, I need to make sure my mortgage payment stays within a certain amount, and you got to also be realistic. Okay, don't try to pretend like you're going to go back to pre-COVID, right, and have that same mortgage payment. And by the way, we're going to do some other videos, and there's possibly a video somewhere over here about talking about the realistic expectation about purchasing a property when you're renting, and telling the loan officer, well, I want the same mortgage payment. I want to have the same mortgage payment that I have. I want to have the same mortgage payment as my rental today. I got to tell you, that's unrealistic. You want to go from an apartment to a house and have the same mortgage payment. You want to double the space. You want to own the property. You want to do all that, and you want to have the same thing. Oh, there's a couple of other things that we can talk about. But either way, going back to, is it real? The number one reason why I believe that having a lower interest rate is not real is because you don't know enough about the industry. You don't know enough about the mortgage and how they're put together to even assess if it's worth it or not, or if you're saving money or you're not. Many people don't know. So you can go to a builder and get, a lower interest rate. Well, where's the money coming from? Do you think that they have separate interest rates? They don't have separate interest rates. What they're doing is that they're putting a profit out of that house to buy down your interest rate. So, yep, some of the margin, some of the money that they're making on selling you the house goes applied toward buying that down. So is it real? I don't know. Is it low enough? I don't know. Number one thing I will tell you is you need to focus on the property price and the value of what you're purchasing rather than the interest rate that you're paying. That's number one reason as to why it's not real. Buy an interest rate for today. Okay. So let's say that you get an 8% interest rate today. Okay. I'm going a little bit high. Okay. Don't kill the messenger. You'll have an 8% interest rate today. Rates are fluctuating ever. Okay. Up, down, up, down. Beginning of 2026, we were right at the high fives. They were phenomenal. Okay. A lot of people kind of jump into that. But let's say that you have an 8%, rates get right back down to 5.5. If you refinance at that time, let's say that you held the property for a year. Number one, what happens to the value on your property? It went up. The demand on your property went up when rates go down. Demands on property go down when rates go up. Okay. A little bit of an inverse relationship between one and another. So does it make sense Does it make sense to go through all of this trouble to do that, when you just simply want to ask, hey, can I get a little bit of a discount on it? That's it. Just do that. And sure, still shop online, and somebody's going to tell you, yeah, you qualify, you qualify. You have any idea how many times I've had, agents and clients just be frustrated, because, some, bucket or whatever, right? Got them qualified and then they didn't. How many times it gets frustrating, with, hey, I want everybody to purchase my property. No, don't do that. Okay. It doesn't, no, the investment is yours. We are selling money. That's what we're doing. Okay. We're figuring out where to find the money and get you qualified so you can purchase a property. It is in your best interest. And if you want to know more about that, you want to challenge me on that, drop it down in the comments. I'd love to have a conversation with you. Otherwise, that's what I got for you guys. So if you have any questions, comments, concerns, or want to go through more of these things, scenarios, drop it down in the comments. Make sure you subscribe, share this, and let me know what your thoughts are on this.